Hi dear traders and investors, this would be very quick video. I will show you what would be your possible loss if you hold Magnificent 7 stocks, all equal weights. We will be calculating with 99% confidence level. So these are Magnificent 7 stocks. Actually, in this video, we will not be undertaking calculations. If you're interested in detailed calculations and step-by-step guidance on how to calculate your portfolio's expected loss using the value at risk model with the 99% confidence level, you can watch my previous video. You can see in the top right corner there is the link to that video, and I will put the link down to the description of this video, so you will be able to analyze your portfolio and see what can be your expected portfolio loss using the VAR model. But in this video, I am not undertaking these detailed calculations just to save your time. And I'm just telling that you need to download the prices, then calculate the returns of Magnificent 7 stocks. The larger the period, the better, the more accurate your calculations would be. The best is to take 3-5 year data for each day. I'm extracting data. In this example, I'm extracting starting from the beginning of the year till the current period. And then we're building the variance covariance matrix, which shows the dependence and the scope of this dependence of each stock in your portfolio. Then I'm assigning, suppose I am distributing equal weights in my portfolio, only Google has a slightly higher weight here. Then calculating the average portfolio return based on those returns that we've extracted. And this would be my portfolio return, which is basically the weighted average of return, including all those weights. Then I calculate the portfolio standard deviation, which is simply the variance. This step calculates the variance from the variance covariance matrix that we've taken taking into account also the stock individual weights. And then from the variance, I take the square root, which would be the standard deviation, or you may heard that analysts refer to it as the volatility. So the stock volatility and standard deviation are the same thing. It shows by how much your portfolio would deviate from the average. And then I'm calculating the risk-less volume using the normal inverse distribution. In this formula, you can see I'm putting 0.01 because we are interested in 99% confidence level. So first I calculate the risk-less volume using the average portfolio return and the standard deviation, and also portfolio value. Let's suppose you're investing $100,000 and your riskless volume would be 96,000. Then I subtract portfolio value from the riskless volume and I get the value at risk, which is your possible expected loss for the portfolio. So if you're holding this Magnificent 7 stocks in equal weights in your portfolio, there is a high probability that your loss would be $3,322 based on yearly, on 10 months observations. But again, the longer your observations, the better it is. And one more time mentioning this, I will put the detailed guidance, the link to the video, to the previous video in the description section, and you can also watch it to understand how to undertake this calculation using the value at risk model. Thank you very much for watching this simple and quick video.